Dave, so we'll see on the news or on social media that the Fed lowered rates. Literally, my father-in-law and I were having this conversation. He's sending me texts. Oh, look at this and look at that. And then the next day, interest rates will go up. And people are like, what? The what?
Yeah.
Talk to me about that, man.
Yeah, those are always my favorite days, right? I wake up to about 25 messages on my phone like, hey, let's refinance. Look, it's... The information is confusing, so I'm going to try and break it down a little bit. Whenever you're hearing that the Fed raised or lowered interest rates, what they're talking about is the federal interbanking overnight lending rate, right? So this is how the cost of money for banks to loan money back and forth to each other, literally overnight. So it's like the shortest term money that you can get, right? But a bank will get that money and then they will give a car payment to somebody else. And the difference from what they borrow it versus what they sell it is a profit margin for the bank. Mortgage interest rates, however, are not based on quick money. In fact, it's based on quite the opposite. It's based on longer term money. So mortgage interest rates are based on the yields of like 10-year and 15-year bonds versus the overnight lending rate. So it's a little confusing to people because what we get is a lot of media attention to it, just with these kind of big overarching statements that interest rates have gone down, which is not wrong. The Fed did lower interest rates, and it certainly does impact consumers, just not necessarily in the way of housing and mortgage rates.
It's not a direct correlation.
That's right.
So should the general consumer just ignore the news that they're getting about them?
No, it all works together. There is indeed a correlation. It's just not a direct correlation, right? So, right now, what happened, if you do a look back over the last 3 years, we were experiencing here in the country just a much more than usual inflationary effect, right? Due to post-COVID and having interest rates being basically kept at zero for so long of a time.
Yeah.
And there's not a lot of tools that the government has to intercede when you have a capitalist market like we have. So the only thing that the central bank has is the ability to raise and lower the federal overnight lending rate, like we just talked about. So they went on a campaign over 33 months of increasing that interest rate at a faster pace than ever historically that has happened before. And what that happened, or the reason they did it, I should say, it was like trying to throw like a bucket of ice water on an overheated economy.
Yeah.
Right? And that, because the definition of inflation is just an increased cost to goods and services. So by making it more expensive to buy these goods and services, it's supposed to inspire Katherine to, do I really need to go out and buy that BMW today, right? Or maybe we should think about saving instead of spending.
Taking pause.
Taking a pause. So, last September in 2024, Fed Chair Powell came out and with a really direct message to the country and said, okay, you all have endured an unprecedented effort for us to get in front of inflation and start getting things back to an acceptable number. And you know what? In large part, it actually worked, right? We're not quite at that magic 2% target that they're trying to get to,
right?
But we've most definitely come down substantially. So he said that the Fed is extremely committed to making sure that they don't keep interest rates elevated, not even 1 day longer than they have to. And they responded that month by, for the first time in literally over 30 months, lowering that federal overnight interest rate by 0.5 point. And they did it 2 additional times by the end of last year. So why is this important? The future is definitely looking better. We don't have a crystal ball. And I think the biggest misconception that consumers have is that the increase and decrease of interest rates is linear, right? Like it's here and it's just going to go down, 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 down. What we know is that if you fast forward 18 to 24 months from now, interest rates will be lower. But the path of getting there is going to be a bit of a roller coaster with little peaks and valleys.
I got you. I was about to ask you what the heck you meant by that. So you answered my question. And, it's true, Dave, because a question that I get from our clients so often is, what do you think is going to happen with interest rates? Because they're trying to decide what to do next and they're trying to figure out what makes sense for them. So, in talking about that direction of the cost of money, as you're saying, I know you said you don't have a crystal ball, but where do you see, you mentioned that it'll go up and down, and overall it'll go down, but like, what do you feel in your gut is going to happen?
Yeah. So, I follow data. Right.
Yes, you do. You are a data nerd, and I love that about you.
Well, in my business, it serves us well, right? Like when I wake up in the morning, before I've rubbed my eyes, I'm already looking at CNBC to find out what happened in Japan yesterday. That's going to affect us here in the United States today. And it's important to have that kind of understanding because every economy is interlinked with each other, right? But here's what we know, right? If you take the smartest economists, universally, we know that interest rates are going to go down, just like I stated before, right? We are over that hump. We're committed to coming down. We just don't have that like crystal ball timeline of how much and when.
Yeah.
But
I think it's safe to say we're not going to get down into the threes again.
No,
I mean,
no,
I
no,
think
no.
some people think that
they're waiting.
They're waiting for it to go back to the threes again, and my heart goes out to them because it's just ill-informed.
Yeah. Well, look, often times people don't realize what drove those interest rates during the pandemic down to the 2.75 and the 3% range. It wasn't because of good news. It was because of really, really, really bad news.
Yeah.
And that's the correlation people need to understand. When things are doing well, interest rates don't go down. They go up. When people are employed and they're making money, and you go to Old Town Temecula on a Friday night and there's like a line outside of restaurants, that means the economy's pumping, consumer confidence is up, and interest rates go up as a result of it. When things are bad, when we're in recessionary periods, when we're in conflict situations, military conflict situations, right? Those are potentially bad situations for the economy. And when we had a situation during the pandemic where literally the economy was basically stopped to a halt.
Felt like we were on a tightrope.
Right, that's right. Mm-hmm. That's when we saw that. So you have to ask yourself, are interest rates ever going to do that again? Well, they had never done it historically prior to that. So that's your first indicator.
Yeah, who's to know?
Now, if this
do we want what it would take for it to be that way?
That's right.
The answer is very likely no.
That's right. There was a lot of pain, a lot of death, a lot of sickness, a lot of elements that were attached to that other than just the mortgage rate. So, but to circle back to your question, where do I think interest rates are going to go? It is highly probable that by the end of this year in 2025, we will be in the lower 6% range, like, a range of 6 to 6.25%, which would be wonderful. Right now, we're in the higher 6% range. But what a lot of people, American memories are short-lived, because just last November, Katherine, we hit 8%.
I remember.
8%. So I have customers all the time where they're like, hey, I'm going to sit and wait till interest rates have gone down. They did by a big, big margin, right? Now, we are going to get lower, and that's really not the question. The question is, what is going to happen to real estate in general as far as purchase prices, overall market sentiment, and competitiveness? That's what really matters, because you might wait for the interest rate to go down and end up paying more for the same house that you could get today.
Prices have gone up.
That's right.
Yeah. I was in a conversation yesterday with a client. We sold his home, and he's renting for a while he figures out his next steps. And, and I hear this a lot. They'll say, I really feel like the market is going to correct. And what they mean by that typically, as I dig in more in the conversation, is they want home prices to come down, because they want home prices to come down. But there's no data to support that. There's nothing to back that up with what's happening in the market. So
again, if you looked historically back, what happens when interest rates go down? Prices go up, right? The more affordable something is, the more somebody's willing to pay for that, right? Which is indicative of, again, I don't mean to keep doing a look back to this COVID environment, but that's really
but it's very relevant.
Yeah, it's what people have like kind of burned into their periphery right now.
Yeah.
And it was because interest rates went down to 3% that prices went up by 22% year over year on homes, which also has never happened historically before.
Yeah. I feel like there's a compound of, it's interesting you mentioned that they have imprinted in their brain right now everything that happened during the pandemic, but I feel like that's also combined with people are still hanging on to that 2008 period, and it's almost like they're waiting for prices to tank and interest rates to tank, and that somehow there's going to be this whole market correction, as you say, or as they say. And I feel like those assumptions, they're not coming from any data points. They're coming from a fear.
So in fact, this morning, in anticipation of being here with you today, I pulled the freshest data from National Association of Realtors, California Association of Realtors, Mortgage Bankers Association, Freddie Mac, Fannie Mae, pretty much
so just a couple.
Yeah, just a few people that have an interest in this, right?
Yeah.
And although there is a variance of the amount of appreciation,
which there always is in the reports.
There always is, right? Mm-hmm. And you just hope we land kind of somewhere in the middle. There's not a single entity that has any credence or authority in the real estate market that has a prospectus that prices are going to go down.
Yeah.
Right. That would be just like a gut feeling based on nothing.
Yeah, I agree. So how can sellers and buyers benefit from understanding that reality and really maximizing their home ownership goals?
Yeah, you got to be strategic.
Not living in fear, but
For sure.
living in strategy, like you said.
So fear, right? That is really the big motivator. It's fear that is driving hesitation for sellers to sell and move on to that next home, for buyers to get into home ownership, certainly for first-time home buyers. Right? There's a lot of fear. And in my experiences, the way that you mitigate fear is with strategic planning. Right? You kind of take the veil of anonymity off all of this stuff. And once it kind of just becomes, it is what it is, you're able to really kind of deal with it more. So that's my answer to that, right? It's creating a strategic plan. But like I mentioned, the road in the future is not going to be linear in one direction or another. It's going to be these series of peaks and valleys, right? And it moves fast. So if we have one of those opportunities where you could really achieve what you're looking for, but you're not prepared and ready to go at that time, Katherine, this could be like a fleeting, like the wind moment, and you might find yourself by the time you get your ducks in a row, it's too late.
That's so frustrating.
Right. So I would recommend working with a team that's willing to invest in you, whether it's 6, 12, 24 months. Like if you are a prospective homeowner and you are talking to your loved ones at home and you're telling yourself, okay, look, we don't know when this is exactly going to be, but we know in the next 3 to 24 months, we want to get into a home. The time to start that campaign, Katherine? Now. 100%. I will tell you, I can do infinitely better creating a really meaningful financial package for somebody when I have 6 months of runway versus, hey, Dave, we found the house of our dreams. We need to get our ducks in a row because we have to buy it today. At that point, it's just like, it is what it is. We have no time to change anything, to optimize anything. We're just left to deal with what we've got.
It's reactive.
Right. It's totally reactive.
Yeah. And it can work, but I think it works best when you can be proactive.
It always does. Whether you're practicing for a baseball game or planning your financial planning with your estate planner, right? Like planning is the way to success for sure.
I agree. Well, I definitely want to encourage anybody watching this, if you are in that mode of wanting to dig in more, have questions answered, you got to call this guy.
Oh, thank you.
And
appreciate it.
We'll have his info below. And hopefully you have found all of this information very valuable. We have so much more. We give you this info every week. So if you haven't already, make sure to like the video and subscribe to the channel so that you can get all of this info and just be empowered. I mean, Dave literally has an Empower Hour, he calls it, which I love. And we want to support you in that. So thank you for watching. And Dave, thank you for spending a few minutes with me.
Thank you, Katherine.